Big banks like Bank of America and the rest of the US banking industry are having a very hard time. Why though? Problems are happening because of a number of things, including the closing of bank branches, changes in customer behavior, and limited funds. But these problems are caused by a lot of other things as well. A lot of bank branches closed in 2024. Bank of America was the first to do this, closing over 100 properties. Wells Fargo, Chase, and other big banks are closing branches all over the country. Florida, California, New York, and Pennsylvania are the states that will be hit the hardest by this trend. According to the banking industry, this change is due to the rise of digital banking, where more customers handle their daily financial needs online. However, these bank closings are just the tip of the iceberg when it comes to the bigger problems US banks are facing. The move to digital banking is like a double-edged sword. Banks like Bank of America are explaining these closures by citing the rising desire for internet banking. Customers are picking to handle their accounts online through websites and apps instead of going to branches. Given how convenient digital banking is, this rise is not a surprise. Thanks to mobile check deposits and internet transfers, many people are going to the bank less often. However, the transition to digital banking causes substantial dangers for traditional organizations. Banks that are only online, like Discover and Chime, have been offering digital services for years, and the terms are often better. Checking and savings accounts at these banks are free, and they don't charge the high fees that other banks do. Also, savings accounts at online banks usually earn more interest than those at traditional banks. Traditional banks' main benefit, their physical presence, is dwindling as more branches close. They might lose customers if they keep charging for services that other companies offer for free. Going digital may save banks money on rent, salaries, and upkeep, but it takes away one of the things that makes them unique. Customers may easily switch to online-only banks that are more competitive, especially if big banks don't change their products and pricing. While digital banking is easy, the closure of branches has various negative consequences for customers. Branches provide vital services, particularly to individuals who require in-person support, such as the elderly, those who do not have internet access, and those who prefer face-to-face encounters for complex financial issues. Furthermore, businesses usually rely on local branches for a variety of banking services, including cash deposits and loan approval. Banks that close branches risk alienating these communities. It's not only the inconvenience of having to travel further to the nearest branch. These closures may also lead to a decrease in customer satisfaction and loyalty. Customers may find themselves without easy access to financial services in areas where multiple banks are closing branches. This could encourage people to consider non-traditional banking solutions like payday lenders, which usually have higher fees and abusive tactics. Closing branches is a cost-effective strategy for banks. The average yearly operating expenditure for a branch is $2.6 million. Eliminating branches allows banks to make significant financial savings. Reduced client access and a probable loss of consumer trust are the costs connected with this cost-cutting method too. Banks that fail to appropriately manage this shift face long-term consequences for customer retention and brand reputation. The more comprehensive economic framework, banks are closing while the United States. In many sectors, corporate profits seem healthy, but this is typically the product of big layoffs and cost-cutting programs rather than true growth. This trend is equally applicable to banks. When banks close branches and lay off employees, they may see an increase in their short-term profits, but this also hides deeper problems. The problems in the banking industry are a reflection of the larger financial problems that many Americans are facing. High interest rates, inflation, and rising living costs are putting pressure on consumers. Homeowners are particularly affected by rising mortgage, property tax, and upkeep costs. They are using home equity lines of credit, HELOCs, as a last resort because they can't keep up with these costs. It is worrying that people are borrowing against their homes to stay alive, as shown by the fact that HELOC balances have been going up for 2 years. Many people are having a harder time because their mortgages are getting bigger and the real estate market is too expensive. Interest rates have gone down a bit, but they are still historically high, which makes it hard for people who already own homes or want to buy homes but are having trouble paying for repairs. Another worrying trend is the rise in subprime mortgage financing. Programs that offer 1% or even 0% down payment options are attracting people who might not have enough savings over time to qualify for homeownership. Some people might be able to get a mortgage through these programs, but they come with a lot of risks. For example, borrowers with low incomes and bad credit may find it hard to make their payments, especially in times of high prices. As a result, there may be more short sales and foreclosures in the coming years, as many homeowners can't keep up with the costs of owning a home. This is similar to the subprime mortgage crisis of 2008, when dishonest lending practices caused a financial meltdown and a wave of foreclosures. The place of big banks in the economy. Big banks like Bank of America have a significant impact on the American economy, and their decisions have wide-ranging effects. The These banks' branch closures are a reflection of broader shifts in the financial environment rather than merely a cost-cutting strategy. In spite of the fact that the circumstances of today may not be as dire, the fundamental problems remain the same. Lenders and banks are giving credit to people who might not be able to pay it back. These institutions are shaping the future of banking, in addition to responding to shifts in consumer behavior, economic difficulties, and technology advancements. If large banks keep closing their offices and pushing their customers to utilize digital banking, the demise of traditional banking services might happen faster. This may lead to a future in which banking options are limited to the internet, which may benefit some but inconvenience others. Moreover, the shift to digital banking could be a forerunner to central banks issuing their own digital currencies, which would fundamentally change the management and governance of money. In general, there is a chance that the actions of big banks may exacerbate economic inequality. The closure of bank branches in low-income communities has reduced access to financial services for those who need them the most. This may lead to a vicious cycle of disadvantage when those who lack access to banking services are pushed to turn to riskier and more costly alternatives. Will banking change in the future or fail? The challenges facing U.S. banks, particularly large ones like Bank of America, highlight the need for reform in the financial sector. The banking industry will inevitably move toward digitalization, but banks must still figure out how to adapt while meeting the needs of their customers. Reducing costs and closing facilities on their own is not a sustainable, long-term strategy. Banks should reevaluate their business plans and focus on providing value to their customers, whether through better online services, lower expenses, or state-of-the-art financial products. Additionally, banks must be conscious of the broader economic landscape in which they operate. Increasing costs, inequality in the economy, and the risks of subprime lending are some of the problems that could jeopardize the stability of the banking sector. If banks disregard these issues, they can face severe challenges later on, such as increased regulation, a drop in customer confidence, and perhaps even another financial crisis. Warren Buffett, the CEO of Berkshire Hathaway, and his successor Greg Abel are exhibiting mistrust, which is making the future of banks, especially Bank of America, even more dubious. SEC filings reveal that Berkshire has sold 150.1 million Bank of America shares for a total of $6.2 billion since July 17. With about $36 billion, 11.4% investment, Berkshire is the bank's largest stakeholder, despite its current